I think investors like ourselves are looking at this market saying it's not sustainable. Something needs to happen because the supply demand just don't match. We're going to need a lot more uranium.
There aren't really any terrible companies in the space. Most of the companies that exist now have survived the bear market. We had 400, 500 companies at the peak of the market in 2007, and we got down to about 45. Now there's about 60, 65 in the space.
There's still a significant demand growth in the world. And even in the US, when we talk about where the spot price is relative to price of production, that's all feeding into this narrative, as Justin said. This is not a short-term investment.
I think that's where a number of those themes that Justin mentions in terms of green finance and ESG investing, and together with that democratization of investment and a more active investment approach from millennials and younger people, they will start concertinaing together. And if SPUT manages to attract some of that investment capital into the uranium space, then yes, there is a potential for a very significant flow of money into the space.
I'm delighted to be hosting this session for Assay Live. It's a very timely and interesting point in the market. Having endured over a decade-long bear market, we enter a new bull market cycle in uranium, and with that comes a great deal of hype and promotion. And so in our session today, we're going to be cutting through the noise to really understand the major drivers of this new bull market. And we'll be hearing from a range of experts on what to expect next and why there's a strong investment rationale for uranium right now. So for the running order, Justin from Uranium Insider will warm us up with a market outlook to set the scene. And then we'll be opening into a panel discussion with each speaker addressing the industry hot topics that we've outlined in turn. And of course, I'd like to remind everyone that this is an interactive session. If you as a viewer have got a question, please feel free to submit your question through the Q&A box you'll see on the controls on your screen. Just type something in there, submit it to us directly or to the panel generally, and I'll scan through those and make sure that we answer those in the second half of this webinar. So welcoming my guest speakers then, I've got an exceptional panel of experts with a background in developing and investing in research resources projects, uranium extraction, commodity trading, economics. The expertise is really there. So we're really pleased to have this group of panelists together. So I'll introduce Brandon Munro, who is the CEO of Bannerman Energy Limited. It's ASX listed explorer with assets in Namibia. Paul Goranson, CEO of enCore Energy Corp, OTC listed developer explorer with properties in the USA. Riaz Rizvi, who is a long-term investor into uranium and natural resource projects and battery metals at Rice Capital Partners and was formerly with Kazatomprom. And Justin Huhn, who is founder of Uranium Insider. So gentlemen, thanks very much for taking time in your respective time zones. I know it's very early and very late in some locations, but we're really happy to bring everyone together for this session. So let's get straight to it. Justin, you're going to kick us off with your market outlook. So please take us away with your opening presentation.
Thanks, Adam. First of all, I'm extremely honored to be here amongst such a fine group of industry heavyweights. I really humbled to be invited to be a part of this. I'm going to fly through a slideshow presentation here to try to cover really the most important aspects of the macro fundamental setup right now for uranium investing and not take up too much time. So we have plenty of time for the Q&A with Paul, Brandon, and Riaz. So I'm going to go ahead and share my screen here. As Adam mentioned, I'm the founder and publisher of the Uranium Insider investing newsletter. We're the only investing newsletter that's solely focused on the uranium space. I've been doing this for a couple of years now. We send out very thorough monthly newsletters and inter-month bulletins with actionable trade alerts. We also have a focus list portfolio of 10 companies in the space that we feel are the best investment cases in uranium. So that's just a brief introduction of us. Getting right into it. So this is something that a lot of people don't know about uranium in the investment case is that nuclear is actually a growth industry. This is an industry that's poised to grow between 1% and 3% out to the end of this decade and beyond, with even greater growth projected out from 2030 to 2040. This is a quick screen grab from the World Nuclear Association. There's 443 reactors currently operating in the world. There's 54 under construction. A big chunk of those are in China, but there's another dozen plus countries that have reactors under construction. 100 planned and 325 proposed. It's becoming more clear by the day that nuclear is a great solution for clean energy going forward. Another part of the growth story is the emergence of SMRs, or small modular reactors. These are a couple of digital images of the proposed NuScale Natrium reactor that's worked on with GE Hitachi. And that is a reactor that is poised to have the first reactor of its kind built in the United States in the state of Wyoming. It's aimed to replace a existing coal power plant that will retire and plug directly into that grid. These are much smaller reactors. They're much safer. They can be built much faster and for far less money. It's a really exciting space. Canada, the United States are pushing really hard in this, as well as China and Russia and a number of other countries. So very exciting to see that element coming forward. The uranium market has entered a multi-year structural supply deficit. So this is from WNA's nuclear fuel report from 2 years ago, from 2019. I believe that there should be another one out this year. Hopefully Brandon can speak on that because he sits on one of the panels for this fuel report. As you can see, this is the reference case. They also put out a lowercase and an uppercase. And the reference case is pretty conservative, I would say, overall with its assumptions. And you can see that the demand for uranium going out, this goes out to 2040, is just a big alligator mouth here. Even with every single project that's planned or proposed comes into production out into the next decade, we still have a projected massive supply deficit. So this really is, part of the investment case is that there's a number of flawed expectations in the space when it comes to nuclear, and I'm going to go over those. First of all is reactor life extensions. So these supply and demand models, like the one that you see in the screen on the lower right there, these models conservatively estimate that reactors that are slated to come offline do come offline for the most part. We're seeing now that earlier this year, EDF in France announced that their reactors would be extended to 2035, which is a 10-year extension. We're seeing that the United States is gaining more support for supporting its existing nuclear fleet. I'll go into that a little bit more in a bit. And Japan, who had, after Fukushima, lowered their maximum life scale of their reactors to 40 years, has now bumped that to 60 years, and they're actually even pushing for life extensions out to 80 years for the plants that get approval to do so. There's assumptions that the Japanese potentially will not restart their reactors as quickly as we had hoped out this past decade after Fukushima. That's certainly come to fruition. We believe that there should have been many more reactors restarted by this point, but they are seemingly accelerating this pace as they have their, like most countries do at this point, their carbon emission goals. So they have 10 reactors restarted right now of the 53, I believe, that they shut down after Fukushima. In order to meet those carbon goals, they'll have to start another, I believe it's 15 to 17 reactors of their idle fleet. So we're watching that closely, but it's looking positive as far as Japan's movement there. There's assumptions that you can just flip new production on and with the flip of a switch, and that's absolutely not the case. Uranium mines are probably the most difficult mines in the world to permit and to get into development, and they take a very, very long time. There's a lot of bureaucratic red tape. There's a lot of capital that needs to be raised. Obviously, that depends on the mine, the geology, the jurisdiction, et cetera. But for the most part, all of these elements take a very long time. On that note, here's a quote from Kazatomprom. By 2030, the market will need new production equivalent to 2 additional Kazatomproms to fill the expected gap between supply and demand. So for those who don't know, Kazatomprom is the largest producer of uranium in the world. They currently produce about 23,000 tons of uranium, which is 58 to 60 million pounds a year. That number is actually 20% below their subsoil use agreements. I'll go into that a little bit more deeply in a minute. But for somebody on the inside at the largest producer in the world saying, yeah, the world's going to need 2 more of us by the end of the decade is an extremely profound statement. That's basically not going to happen. So, and especially not at these prices. We really, really need much higher prices, much more capital incentive to come into the space to even remotely get close to that level of supply. And the other, another common assumption is that the big producers, primarily Kazatomprom and up and coming producers in Uzbekistan, can ramp production to meet that gap in supply. And that's simply not the case. And care and maintenance mines as well coming in to balance the market. So if you take a look at that WNA graph there, you see that with the care and maintenance mines, that's the yellow portion of that bar graph in 2024. That looks like that's MacArthur River and possibly even Paladin's Langer Heinrich coming back online to quote unquote balance the market for a tiny blip in time. That's basically irrelevant when it comes to the uranium market, where we have a growing nuclear fleet worldwide that's going to need to secure supply out to the end of the decade and beyond. The other assumption, secondary supply will remain consistent. While there is increasing enrichment capacity coming online in a couple of different countries, primarily China, most of the secondary supply that comes into the uranium market right now comes from the enrichers, both in underfeeding and tails re-enrichment. Both of those, I won't go into that right now because I don't have the time, but both of those elements of underfeeding will be reduced with increased demand for enrichment. And we're already seeing that in the market now. Tim Gitzel was quoted saying that or it might have been Grant Isaac, from Cameco, saying that underfeeding has already been close to cut in half in the annual amount that it's coming into the market, from 20-something million pounds to around 10 million pounds a year, simply over the course of a few years. So the assumption that that will remain consistent, I believe, is incorrect. Production discipline. So the 2 primary producers in the space, Kazatomprom and Cameco, have both they've both shown great discipline with the market. This graph is showing Kazakhstan's production over the past number of years. And you can see 2020 was a big drop. Part of that had to do with COVID, but they have expressed, and this graph doesn't show it, but even out through 2023 to remain in a 20% cut in production below their subsoil use agreements out to 2023, stating that they're still not receiving the signals from the market to justify ramping that production up to their stated capacity. So that's a great sign to see the big producers in the space showing that discipline. Cameco as well halted MacArthur River in 2018, halted Rabbit Lake a couple of years before that. Overall, the production that they've taken offline, combined with the purchases that offline production has spurred, has a 100 million pound effect from Cameco alone. Cut through 2023, I already covered that. Another big part of this investment case that's seemingly growing at a very fast pace is that the ESG and climate imperative countries are pounding the table on this around the world. ESG stands for environmental social governance, and it's basically a methodology to show that a company is acting responsibly in one or all of these manners. In the climate imperative, you can see that nuclear, another screen grab from World Nuclear Association. Nuclear is the lowest carbon emitting source of baseload energy in the world, even lower than hydro. In fact, half of the carbon production of hydro in the lifespan of that energy production. It's astounding. Obviously, you have wind coming in lower than that, but wind is not baseload. Wind requires baseload energy to support its intermittency and or storage, which is just not there yet. So a number of corporations around the world are adopting these ESG frameworks in response to managed investment criteria. So basically what that means is that managed money is getting increasing pressure from their investors to put their invested capital into companies that are acting responsibly in this ESG framework. And that's seemingly growing quite quickly. I won't go too deep into this, but renewables, they have their place in my opinion, but I don't believe that they can make up a large portion of any electrical grid. They aren't baseload power. They require grid scale storage, which is in its infancy and just not reliable at this stage. They also require base load that can cycle up and down. So what that means is, the sun shines during the day and not at night. It's not always windy. So when you have these intermittent renewables providing energy into the grid, they have to have another source of energy backing them up to make up for when they're not producing. And anytime, you have a nuclear plant come offline and you say, oh, we're going to ramp that and we're going to meet that lacking of supply with renewables, it basically doesn't work very well. As we've seen in Germany, they shut down more than half their reactors after Fukushima. They're slated to shut down the rest of their reactors in the next couple of years. They went all out renewables, $500 billion into wind and solar, and it hasn't worked out too well for them. They have the most expensive electricity in Europe, and they have some of the worst air quality because what has happened? Without bringing that nuclear back online, they've had to ramp coal and biomass energy, and it's just not worked out very well at all for them. And we're also hearing about, now that solar has been pushed for a couple of decades pretty hard, these solar panels have a limited lifespan and there's no real solution for what to do with them. So these panels that are loaded with heavy metals are being thrown into landfills. It's not that great of a solution. This is a term, electron accountability, that was coined by Grant Isaac from Cameco, I believe, who is basically stating that companies are coming under increasing pressure to actually be accountable for where they're buying their energy from. So to the extent that they can purchase their energy from clean sources, investors are happy. Last point on this, Bloomberg article from earlier this year, ESG assets may hit 53 trillion by 2025, which would be a third of assets under management. That's huge growth. And if nuclear and uranium get even a tiny slice of that pie, it's very positive. So the transformation of nuclear sentiment in America has been kind of a surprise. Honestly, we did not expect to see this sort of support coming from the Democrats that are in power in the United States at this point. Here's a quote from the new Secretary of Energy, Jennifer Granholm. I'm telling you, those investments into nuclear would solve the nuclear plant retirement issue in one fell swoop. It's big. So the point is, this administration sees these next few years as truly can't miss opportunity in nuclear energy. The reason I bring this up is the United States at this point still is the largest producer of nuclear energy. It makes up 19% of our grid. There are 91 reactors, 93 reactors, low 90s in operation in the United States. And to the extent that we're seeing support from the federal government for the existing fleet is really profound. Biden's budget was just announced yesterday, the day before. $6 billion in aid for nuclear power. I don't believe this budget has yet passed, but it's likely to pass or something resembling what has been proposed. That money primarily is to aid reactors that are on the fence of profitability and keep them from shutting down prematurely. Which, by the way, hopefully that will actually support the Byron and the Dresden plants in Illinois that are run by Exelon that are on the chopping block in the next couple of months because of profitability issues. So hopefully those will get extended with this new federal support. The American Nuclear Infrastructure Act is another bipartisan proposed act coming from both Democrats and Republicans to reestablish American and international competitiveness and global leadership. This is something that the United States used to be quite prominent with. They have fallen out of favor. That's been taken over by China and Russia, that are doing an astounding job, especially Russia, in exporting reactors around the world. They are selling the designs, they are building the plants, they're training the workforce, they're providing the fuel, they're dealing with the decommissioning and the waste disposal. So it's quite the business model, and the Russians are killing it, which is great. The United States is also wanting a piece of that pie. The ANIA also aims to expand nuclear energy through advanced nuclear technologies. I already mentioned the SMRs coming from NuScale and companies like TerraPower. There are a number of others. There's big support for that. That's great. And of course, to preserve the existing fleet, revitalize the supply chain infrastructure. The nitty gritty on this, I don't know how that will support the uranium production supply chain at this point, but at least that language is there. We'd like to see something there for miners. We'll see how that rolls out. And then obviously that pilot SMR to be built in Wyoming that I mentioned earlier. Oh, the timeline for that is fantastic. They're aiming to start construction within a couple of years and potentially have an operating license by 2026. This is way, way faster than anybody expected these to come online. So if they can even come close to that timeline, that's incredibly bullish for SMRs in general. And we think that that has a high likelihood of happening, especially in the state of Wyoming. Lastly, the financialization of the uranium market. This is the big one. This really is what set the market alight in December. So we had the price of uranium in December of last year. We had the price of uranium not really moving, and all of a sudden capital started flowing into the space. People were scratching their heads. What the heck is going on? Investment money, institutional investment money came into uranium in a big way in the past 8 months. And we believe that's here to stay and only the beginning. But really, if we backtrack, the financialization really kind of began with Uranium Participation Corporation in 2005. This is a physical uranium fund that came into the space to buy physical uranium. That's it. That was their stated purpose. And they've done that since then. They've recently been taken over by Sprott. I'm going to talk a little bit more about that in a minute. This really accelerated this year. We've had a number of pounds acquired by pre-production companies, around 13 million pounds this year. That was Denison Mines, UEC, enCore Energy, Boss, Uranium Royalty Corporation. I believe I'm missing a few, but you get the point. These are companies that are not producing yet, but they're buying uranium off the open market. Not only because they feel that it's an attractive asset to hold on their balance sheet with a bull market that's basically in its infancy, but also for some of these companies to secure contracts. It helps the utilities to entrust that the company will be able to provide, given that they already have pounds on their balance sheet. Yellowcake, based out of London, and UPC have bought about 5 to 6 million pounds this year. Yellowcake gets their pounds from Kazatomprom. UPC buys primarily from the spot market. Hedge funds are coming into the space. Anchorage Capital bought 2 million pounds this year. We've even seen a family fund out of California buy, 100,000 pounds, scraping together money from family funds and buying uranium off the open market. How much more is this going to happen? We don't know. Who's next? I don't know. The arrival of Sprott Physical Uranium Trust. Note the larger font in the underline. This is a biggie. Sprott has been working on this deal for almost 3 years. They've now taken over management of Uranium Participation Corporation. They are actively seeking a ATM vehicle. I'll explain that in a second. Sprott is a very experienced and market savvy sponsor. They have 12 billion assets under management currently in their physical trust. That's gold, silver, platinum, palladium. And they have been cornering the uranium market in this deal for a number of years. And the deal has just gone through, was approved by shareholders a few weeks ago. They are currently seeking an ATM financing model. What that means is that is an at-the-market financing. This should be live in about 2 weeks from this point, from today. So, or maybe a little bit longer, mid to late August. And what that means is as funds flow into this stock and they're at any sort of premium to their net asset value, they can issue shares on the ATM and keep a consistent bid in the spot market. It's a little bit complex to explain exactly how this happens. And even Sprott doesn't know exactly what this is going to look like, because the big unknown is how much uranium is out there in the spot market, at what price and at what delivery time. And even they do not know that until the money starts to flow in, and their trader will be able to reach out into the market and kind of seek out what's there. This is a profound development in the uranium market, in my opinion. And I believe that this is going to put a lot of pressure and be a consistent bid in the spot market, which could get a lot of things moving. Lastly, they plan to file for a New York Stock Exchange listing. This is going to take a little while. There's probably going to be some pushback from the utilities on that front. I'd be curious to hear what our panelists have to say on that, if anybody is curious on that as well. This is probably going to be a Q1, Q2 story. The New York Stock Exchange is about 10 times the size of the TSX. So even on the TSX and with the ATM, they're going to be able to make some moves. But this is really kind of the big play. So assuming they get that at some point in the first or second quarter of next year, that's really going to put a lot of pressure on the physical markets. In closing, sorry to be rushing through this. I just want to give enough time for everybody to speak. What do investors need to know? If you're just coming to this investment thesis and you're compelled by what you just heard and what you're about to hear from our panelists, what do you need to know? Be patient. Have a multi-year perspective. This is not a trade that you're going to be in and out of in a number of months. If you buy into this sector and expect it to move in a short period of time and it does not, you're going to get bumped out. It's very, very volatile. So keep a multi-year perspective. The development of Sprott, I believe, is going to have an accelerating effect on the market. prior to that development. Honestly, I thought that this would be a more long-term, healthy uptrend. I still think that's possible, but I think the potential for a price spike, like what you're seeing in the backdrop of this image here, has some potential as well. So even with the price spike situation, I do still see this as at least a 2 or 3 year investment, if not longer, and potentially it could be much longer. Understand that outsized investment returns can only come with heightened volatility. Again, the attractiveness of the uranium sector is the volatility and the potential for these investment returns to be very, very large. That can only come with volatility to the downside as well. So be ready for that. Understand the fundamental long-term bullish thesis for the price of uranium. You have to at least have a grasp of what's going on in the space to really hold through the volatility. Invest with experienced, shareholder-friendly management teams that possess quality projects. We've got a couple of those folks here right now. We really like to invest in management companies primarily. That's the thing that we look at first, is the management teams. That's the number one criteria. Quality projects is a big one as well. There's a number of other investment criteria that we look at. I won't go into, but that's the primary thing we look at. This is a very complex sector to understand. I suggest that if you're coming into this investment thesis, that you spend some time on it, that you read as much as you can, and soft pitch conviction is essential. Seek professional advice. We highly recommend, obviously, our newsletter service. We are 100% focused on the space, and we know the sector inside and out. If you're not into that, please do a lot of reading. Understand that this is a very complex sector, and it's a very exciting sector. The news flow comes in almost on a daily basis, and there's really some big things coming for this sector, I believe. And that's my pitch. I hope that you enjoyed it. I hope that if you're new to this sector, that you feel intrigued at the very least by this investment thesis. And on that note, I'm going to stop the screen share and turn it over. Did that work?
It did work. Excellent. Thank you, Justin.
Thank you so much.
Yeah, no, you're welcome. Thank you for that excellent presentation. It really frames the situation very well and sets us up for a good discussion. I had one question actually off the bat of that around the reactor building. And so you mentioned a lot around what's going on in the US, but are the Chinese building more reactors at the moment? Is that adding to this demand side picture as well?
It is. I mean, it's assumed that the Chinese are holding a large amount of inventory, but that said, they still are, seeking pounds. They just announced a deal with Kazatomprom with a JV project on their Ortalyk project. That said, they get a lot of offtake from Kazatomprom as well. They own the Husab mine in Namibia, which is under production currently. They own a stake in Fission. They own a stake in Rossing. They own a stake in Paladin. So they, even though they're sitting on a large inventory, they still clearly have a very, very long-term outlook for the sector. And they're building 20-something reactors currently right now under construction. They're going all out on nuclear. So we believe that they will continue to seek more production out in, across the globe during this market.
Yep, certainly. Okay, that's great. That captured it very well. I had a lot of questions flying in, and then some of them around the sort of spot price, but I wanted to just introduce all of our panelists first, bring everyone into the discussion before we tackle that. And I think if I could ask everyone just to give their sort of take on perhaps what Justin's presented, and then we can delve into some of the prepared questions and some of the audience questions that we're getting. So Brandon, maybe I can start with you and bring you in here. Just for your quick take or anything that you might wanted to add to what Justin's covered so far.
Thanks, Adam. Look, Justin did a great job, as he always does. Set the scene, and I think concluding on the financialization of the uranium sector is exactly where the attention is for investors and market players at the moment. There's a lot of anticipation, as Justin said, about what the Sprott Physical Uranium Trust can do. And the utilities have got good memories, or let's say long memories, of the impact of a number of financial players during the last boom, starting with ADIT Capital back in 2004, when they really set the scene for the volatility that we experienced through buying pounds. What's really changed, though, since those days is the advent of social media, the democratization of investing, and what SPUT is doing already in Canada, but certainly seeks to do in the US, is position uranium as a much more accessible investment. And I think that's where a number of those themes that Justin mentions in terms of green finance and ESG investing, and together with that democratization of investment and a more active investment approach from millennials and younger people, they will start concertinaing together. And if SPUT manages to attract some of that investment capital into the uranium space, then yes, there is a potential for a very significant flow of money into the space.
Excellent. Paul, could I bring you in here and get your quick take?
Yeah, well, first of all, I want to compliment Justin on his presentation, because on that last slide he showed that historic price curve for the price of uranium. And I just want you to know I've worked throughout the entire width of that curve on the x-axis, so I've gotten to see it all. And I think it's a very good point that he made during the presentation, that when we saw the last real price spike, it was driven quite a bit by financial players, hedge funds, et cetera. Some of those we still see today, and different vehicles that are out there right now, but it was really driven quite a bit by financial players as they started acquiring supply, or at least taking supply off the market. And we're in a situation now in the market where, you know, we talk a lot about the financial players, but we got to also talk about the demand side. There's still a significant demand growth in the world, and even in the U.S. You know, when we talk about where the spot price is relative to price of production, that's all feeding into this narrative. As Justin said, this is not a short-term investment. This is something you have to do over a couple of years, because the demand is going to be coming in as the nuclear utilities begin to need material. Currently, they can work off of spots, off of inventories. We've seen historic inventory levels when the price is really cheap in the $18 to $20 per pound range. And as inventories are built up, but also secondary supplies driven by enriched or underfeeding, all those things are changing. The dynamics are changing as underfeeding and secondary supply is dropping off. We're starting to see inventories drawn down. And so the expectation over the next couple of years, we'll start to see demand coming back into the market. And that's consistent with what one hears directly from the utility. So whether it's more short-term financial players, a long-term story of supply, demand, and entering the market, I think the thesis of the investment still remains very sound.
Excellent. And Riaz, I'll bring you in. Obviously, quite a lot's been covered, but do you have anything that you might like to add or summarize just before we delve into some more specific questions?
Yeah, as they say, everything's already been said, but not by everybody. So I'll say it again. Actually, you know, I think Justin did a great job of kind of explaining where we are. But if you have the benefit of Brandon Paul's experience from back in 2004, I think the pertinent question is 2024 going to be a repeat of 2004? And if we go back to 2004, the similarities are, you know, shocking, really. In 2004, the world starts to care about emissions. You have the EU ETS and the Kyoto Agreement, which are brewing. Nuclear new build is picking up pace very significantly. There has been a period of a decade to a decade and a half of underinvestment in uranium. So mines will not be able to respond to an increase in demand anything like as fast as what one would expect. There are a couple of natural disasters at some pretty key mines. That hasn't happened yet, but we did see COVID last year, and we saw how vulnerable this industry can be to that type of event. Utilities sitting on low inventory, which obviously is always the case when you see falling prices. People don't want to carry inventory in a falling market. And a lot has been said about the funds piling in. That was really much more towards the end. And I think that's a catalyst or almost an enzyme that accelerates the price movement. But you need these fundamental building blocks to fall into place first. And fast forward to 2020, 2021, we're seeing many of the same factors coming back into play again. And we'll go on to talk, I'm sure, about where we are in that cycle right now. But it's striking how similar the conditions are. And just to remember that, what happened in 2004 ended up with prices reaching $140 per pound. We're in a $30 per pound market environment today.
Excellent. That's a great point. We actually had a question just come in from Frank Tucker around, how would the panel view the expected capital flows coming into the cycle now to 2004 to 2006 bull cycle. So sort of coming back to what you said, Riaz, do you think the capital flows coming in are similar as well to that period?
Well, I think uranium is a very easy investment case in the sense that it's very easy to understand. It's fundamentally driven. You know that there are long lead times, both in terms of supply and in terms of demand. You can count the number of mines. You can count the number of reactors. And there's no substitute to uranium. So it's actually very easy to figure out what demand looks like. It's quite easy to figure out what supply looks like. And it's a very attractive asset class because it's completely uncorrelated to anything else. What's lacking, and we've had a few little run-ups, because if we go back to 2018, prices were running up from lows of $18 to about $30, which is where they are today. We have had a few run-ups, but I think what really drives investors, parking to one side the impact of a yellow cake or a Sprott, which has the potential to fundamentally change how pricing happens. But barring that, I think really the money flows once the momentum is clear. And I think investors like ourselves are looking at this market saying it's not sustainable. Something needs to happen because the supply demand just don't match. We're going to need a lot more uranium. But it comes down to timing. And timing is all about at what point do we see that inflection between supply and demand, where suddenly we start to see utilities come back in, inventories start to build, strategic buyers start to come back in. And after all of that, we might see some very large institutional players come in. And I'm not sure how this market can supply any significant demand. But Sprott is a little bit of a special case, and we'll probably touch on it in a second.
Yeah, definitely. Let's jump onto that as my sort of first question to the group. Could we get a take on what's happening with Sprott now? What could be their buying strategy? Is this the catalyst that's going to kick the spot price much higher? Or is it more nuanced than that? And if so, why? I believe we had a good question around it as well. So I'll tie that in. Adam Greaves talking about the Sprott ATM and buying physical uranium. Is it clear how far the Sprott ATM plans to buy the physical uranium, immediate delivery of 1 month, 3 month, or 12-month contracts? How will this impact the spot price? So there you go. Let's go around the panel and get a view there. Anyone want to jump in first on that?
Okay.
Yep.
Well, I'll get started, and then
Please.
I'll let others jump in.
Yeah.
Obviously, we don't know as I think even Justin brought up, is that we don't have full knowledge of what Sprott's strategy is, but it is going to be, I think the consensus is it's going to be pretty much a game changer with respect to providing a significant financial demand for physical uranium. One would think that the best strategy would be buy directly off of immediate deliveries, or 30-day to 6-month delivery times, in order to to try to drive higher prices. In other words, pull supply off the market to get to begin to improve the value of the asset they're purchasing. But it's hard to say right now. But I do know that the brokerage company that's working for them have good, solid people running that. So I think they're going to get some good advice on that. I'll pass it on to whoever's next.
Yep, Brandon.
Thanks, Adam. Just echoing, there's a number of unknowns, and there's the unstated unknowns and the unknown strategy behind what's stated as well, because any good financial manager is careful to make a distinction between those two. One thing that fascinates me, and I pose it more as a question rather than proclaim to have the answer here, but if they start to see very significant flows of funds, particularly associated with listing in the US, they will want to be quite careful as to how they then take that money in and deploy it into the spot market. In a sense, volatility in the short term won't be Sprott's friend, because let's say they take $500 million for argument's sake, and in a momentum case, I think that money will get thrown at them quite liberally. If they take $500 million and they don't have the capacity to immediately deploy that money, it doesn't do a fund like this any good to hold cash. But equally, if the spot price jerks up too much because they throw that money at a wall, that'll make it hard for subsequent raising. So I would imagine that their strategy would be more around tightening and a slow build, at least until they've got their US listing away and had the chance to enlarge the fund off the back of that more significant capital market. But I don't have that answer as such, so I'm really interested in what the other perspectives are.
Justin, would you like to comment again? You raised some great points in your presentation on potentially what Sprott's UPC's deal is going to do to the market.
Right. I mean, on the heels of what Brandon said, their prospectus is filled with legal language that essentially allows them to do a lot. To buy on any delivery curve. They aren't committing to buying on front month delivery out just a few months. However, you have to take into context who Sprott is, what they've done with the physical metals markets, how long they've been working on this deal, and what their goal is. Their goal is to grow this into a extremely liquid, very large fund that's attractive to institutional investors. They want to grow the fund, and by buying too far out on the curve, to Brandon's point, allowing for, let's say, short to mid-term production increases to meet those demands will not necessarily move the price up in a manner that will be accretive to the investors that are coming into that. That's not to even mention what Sprott and Sprott's associates are invested on the equities side of things, which will obviously benefit from a rising spot price. So there's just a number of spinning elements to this equation that we don't really know how it's going to play out yet. They're going to basically, let's say they've got $50 million of interest wanting to come in, buy $50 million of shares in SPUT. They'll then go to their advisor and the trader, and they'll reach out into the market, see what's out there, what's available for the existing spot price, what's available for a slightly higher spot price, something close to the premium to the NAV that they're trading at the time of that raise, and how far out can it be delivered, or how quickly can it be delivered, more importantly. But all of that said, I believe that their goal is to grow this vehicle, and the way that that happens is to have an influence on the market in terms of raising the price of uranium. That's what's going to create this flywheel effect and keep the money coming into the vehicle, into the sector, and lifting their equities investments. So even though they're allowed to buy out on the curve according to their prospectus, we believe that they're going to push for as fast delivery as possible that's available, that doesn't create this rounding error by holding cash, because the amount of uranium available doesn't fit the size of the investments coming into that. I don't know if I explained that very well, but basically, long story short, we just all are going to have to wait and see. But Sprott, they don't mess around. They're not here to be friends of the industry. They're here to grow their investment and grow their vehicle.
Yeah, fair point. Riaz, something to add or to summarize the thoughts on Sprott for the moment?
Yeah, well, it's not necessarily Sprott specifically, although the fact that they can raise money fairly quickly and easily and deploy that into the physical market, I think is significant. But more generally about the role that vehicles like Sprott, like Yellowcake and others will have going forward. I mean, we've just gone through 10 years of bear market where essentially utilities were better off just holding back on buying material because the longer they waited, the cheaper it got. And that kind of turned around in 2018. And I see a lot of the questions revolve around why isn't the price going up? So in 2018, we started to see supply discipline amongst the producers, and supply and demand start to come into balance. So, if an oversupplied market is a $20 market, a balanced market is a $30 to $40 market. And that's kind of where we are right now. One of the key features of the uranium market has been the long-term nature of the contracts, sometimes 5 to 10 years between utilities and producers. Those covered much of the last decade. So supply and demand really hasn't had a chance to work. Another key feature that we've seen over the last 5 to 10 years is traders and other intermediaries buying in the spot market and selling 1 to 3 years out. And that's the enabler. That's what's essentially allowed utilities to continue to defer those discussions with producers about long-term contracts. But if there's no material in the spot market, then those traders can't offer the material at spot plus interest rate, which is effectively negative today. So the fact that the traders have been able to buy material in the spot market has really flattened the curve out and has made it a very comfortable situation for buyers to continue to roll those decisions 1 to 3 years out. Now, when a Sprott is sitting in the market with a bid there day in, day out, or when other financials start to come and try and pick up some physical material in the spot market, and the next RFP, which is a 2024, 2025 delivery RFP, comes out, and you can't buy the material in size in the spot market to carry it at a practically risk-free rate, what happens then? Right? And that, to me, is the fundamental catalyst that changes the discussion from a utility talking to a risk intermediary like a trader or a bank to utilities coming back and sitting down with the producers. And that's not a bad thing, because producers will absolutely need to reinvest in their mines in order to meet the demand, as Justin pointed out. By 2030 is a significant amount of new material that needs to come into the market. The producers aren't going to sign long-term deals at the sorts of prices that a trader will carry material for 1 to 3 years' time. They're not going to lock in losses, and they're going to have to recoup that huge capex that they need to put into the ground to bring that supply to the market. So that to me is the really interesting dynamic that we are starting to see, and I think that will accelerate, and it'll go faster the bigger and the more successful vehicles like Sprott are.
Excellent summation, Riaz. And to hone in on one of those points, because we had a question about the utilities companies traditionally renegotiating contracts around September, the autumn period. Is that still on the cards? Is that expected to be the case, and that we'll see those conversations being had in September?
Yeah, I mean, typically we all get together in London. That's probably not going to happen this year.
Virtually, I'm sure.
That is that's a typical buying cycle, but utilities have not really been under huge pressure to buy in the spot market. So what we're starting to see is utilities buying a little further out the curve. We're starting to see buyers looking for 25 to 30. That's a new discussion. I'm not sure how successful those discussions are, because I think there's quite a big expectation gap between what a utility would like to pay in 2030 and what a producer would be willing to sell in 2030. But I think that's really where the conversations are going to start to migrate to. And timing wise, yeah, I mean, it's a quiet couple of months over the summer, but typically September is when things start to happen again.
Yep. Okay, great. We've covered quite a bit, and time is getting away from us. So I want to talk about a little bit more about the capital flowing into the sector. I think I took from a report that Justin also cited in his presentation around ETFs reaching 16 billion in 2021 for clean energy focused ETFs, from as little as 4 billion pre-pandemic. That's from Bloomberg. And then uranium ETFs quadrupling within that same time period to around 4 billion over the next few years. Clearly, uranium is sort of fitting into this ESG cleaner fuel agenda, and that's quite significant. And I just wanted to get everyone's sort of take on what this means for capital flows into the sector and what it means for your sort of conversations or positioning as businesses, indeed, because the case is clearly there that uranium is going to be the baseload power on a sort of decarbonised world. So I wonder if we could go around the panel and touch on this, the ESG elements within your businesses.
Okay, well, I'm quite happy to start the conversation on that one.
Yeah, please.
So look, as a first proposition, uraniums as an industry have been very focused on ESG. We just used to give it a different name. We used to call it CSR or CSI and various other things. And the reason that we as an industry were very much on the front end of this trend is because we had greater external accountability because we're a controversial industry, and we certainly were in those days. And there were various interest groups and NGOs and government regulators and so forth who quite enjoyed having a crack at a uranium mine or a project for that matter. So it just made sensible business planning and strategy to invest heavily in this and just make sure that you were doing a lot of good at the time. And I can remember in 2009 when I first moved to Namibia with Bannerman, heading up Bannerman's CSR program. And there wasn't a single dissenting voice on the board when I started to put some pretty big numbers in front of them in terms of the budget that I wanted to play with in country. So we've been doing it for a long time, and the operators who didn't see the importance of that have largely been filtered out as sort of unnecessary dinosaurs, you could say. What we aren't good at, though, is shouting from the rooftops and telling the investment public as well as our constituencies and our host communities just how good we are. And that's what is slowly starting to change. We're seeing leadership from Cameco on this, where they're starting to talk with a lot of conviction about, by definition, a uranium project or mine is ESG friendly because of the enormous power with which we can influence the decarbonisation debate. Plus, we're doing all this great stuff with communities and education and so forth. So we've got a great platform for it as an industry, and investors are starting to realise that. It's just that there's more that needs to be done by the industry itself.
Yep, certainly. That's excellent. Summarised it well. Paul, do you have something to add?
Yeah, I'll second what Brandon said. We've been doing this business for quite some time, and due to the scrutiny, we've had to kind of operate at a level above our competitors, whether it's fossil fuels, coal, oil and gas. Our accountability to regulators as well as to NGOs, et cetera, has been a significantly marked higher. And in the past, and I think this is why you don't see us having a habit about shouting about it from the rooftop, is that, being in this business like I have, you typically want to keep your head down to keep the NGO or anybody from coming at you. So you want to work quietly and typically just go about your business, do it at a point where you cause no impact or any kind of alarm, so that you could go about and do what we like to do, which is put yellow cake into a can. But now with this greater attention, it does provide us a vehicle to talk about our successes. And that's been one of the things that, speaking from a US perspective, is I think we've been able to do is that there's just so much documentation and so much history and et cetera that shows that just the environmental and local, at least in the communities, the successes and the milestones we've accomplished since the 50s and 60s as the regulatory environment changed, but also the way we operate. We're even though in the US we operate with really strict and high levels of regulation, we're still able to be competitive and, with half the production in the world. We can be competitive and advance our projects. But that's because we've learned how to work within that environment. And I think that helps give us a good selling point as well, in the market from the ESG point of view, is that what we have to do is transform what we do to the government agencies and put those out to the public through our corporate communications to demonstrate that not only do we talk the talk, but we're also walking the walk. And in our case, we also work within communities that are often have lower incomes and more closer to, and have a lot of local communities that have a lot of ties to indigenous communities. And so we have to also work within those scopes as well. So having the ability to talk about what we're able to do gives us a lot of strength to, I think, from a perspective of being able to show value, not only as a company, but also to the communities where we work.
Absolutely. Excellent. Look, we're rapidly running out of time, so I want to jump now. We've heard that from the companies. So I want to jump onto the investment aspects and talk about investing in equities in uranium companies, whether it's the juniors or it's the two large major producers that we've spoken a lot about. There's been a couple of questions on various angles around how to invest, what's the best timing, what's going to be the next trigger for. So I want to try and capture those in one cohesive response. Riaz, maybe I could turn to you as the investor on the panel. What's your approach to advice capital, and how do you view the equities at the moment? Do you think there's been a sort of revaluation of the juniors based on this positive sentiment, and we've sort of hit a bit of a plateau? Do you think things have jumped ahead? And also, what's your strategy? Would you look at holding a broad catchment of uranium juniors and the majors as well? What's your thoughts there on the equities approach?
Yeah, I think back end of last year and continued into the beginning of this year, we saw a lot of inflow of capital into the equity space, and it was a great investment, driven primarily, I think, by ESG concerns, which has really investors with a lot of ESG dollars looking for a very small pool of opportunities that really tick the box. And I think clean energy transition is one of the hot topics, and uranium and nuclear sit right in the middle of that. So I think money will continue to chase the opportunities, looking for the best equities in that space. As I said before, uranium is very easy as a thesis. It's quite hard to implement as a strategy, because if you're a fund of any size, any meaningful size, you have maybe 3 or 4 companies that you can really invest in. If you're going to deploy $100-200 million, you've got a Cameco, you've got a Kazatomprom, which are in the $5+ billion market caps. You've got Sprott, which is we're still only talking about $630 million. So the equities are quite limited. Now, obviously, the juniors are going to give you potentially much more leverage or accelerated returns. I think a lot of that was played out. I'm not saying there isn't more there, but there are 2 other ways that you can play the space. You can obviously go into the projects themselves. Now, that's quite difficult to do, but that's really where our focus is. Or you can participate in the physical. And if you have a small portfolio, if you're deploying in the millions or tens of millions of dollars, then a yellow cake or a Sprott are a great option. If you're trying to do a little bit bigger than that, again, liquidity is going to be a problem for you. So there isn't, I don't think, one specific strategy. It comes down to your time horizon, your risk profile, and how much you're trying to deploy in the space. But personally, if equities are currently valued at an implied uranium price of $60, and the physical is still at 30, and you can get into projects even cheaper than that, that's kind of where I'd be looking.
Yeah, absolutely. Excellent. And Justin, can I turn to you? Obviously you have your letter, you cover the companies extensively, but is there anything that you would like to add in terms of the approach to investment decisions on the equities?
I think, look, we're not naive. This is not the very bottom of the market anymore. This is probably the first, maybe the second inning, maybe the third inning. Is there much upside still on the table? Absolutely. We really have no idea how the price of uranium is going to respond to all of the elements that we've mentioned already. We like to suggest to have a diversified portfolio, obviously, based on the volatility that we can see in the space. Personally, for our newsletter, we like to focus on companies that we believe have individual company catalysts that can be accretive to investors, even if the uranium market doesn't move in the way we all expect it to. And when it does move the way we expect it to, it's kind of a bonus. So companies that are making moves in the market and progressing their projects, maintaining relevancy to the market is really what we look for, alongside with what I mentioned earlier with good management teams and good projects. There's not a lot of companies in the space, and to Riaz's point, that when real money comes into the space, everything moves really hard, and you'll see the ETFs and the large caps move first when institutional money comes in, and then as we saw kind of this lagging effect with the juniors, as soon as the ETFs started indiscriminately buying all of their holdings, then the juniors all started to move and move and move and move and move. And that's just kind of how it works. So that, and also being that there aren't that many companies that are large enough for institutional investors, that's also why we believe Sprott is going to seek to grow that fund relatively quickly, so that when they do come onto the New York Stock Exchange, they'll be attractive to larger investors at that point. I think it's really quite the setup, and there aren't really any terrible companies in the space. Most of the companies that exist now have survived the bear market. We had 400, 500 companies at the peak of the market in 2007, and we got down to about 45. Now there's about 60, 65 in the space. So, obviously the returns can be quite different, and there's much more leverage with the juniors, but it really depends on individual investor requirements, based on liquidity, based on risk tolerance, goals of what you're wanting to achieve out of this investment. So it really kind of depends on an individual basis, but for the most part, we really like to invest in developing companies.
Certainly. Excellent. That covers it really well. I'm very conscious of time, and if anyone on the panel has to shoot off, by all means do. But if everyone's comfortable, we can rattle through a couple more questions just to give the audience a little bit more of what they're asking, because I've still got a good 10 questions up here that we could tackle some of those. Okay, let's do that. Great. If you were Yellow Cake, how would you react to the SPUT situation? I assume it's good for the market, it's good for everyone, really. Yellow Cake, would keep doing what they're doing very well. They're just another quality player out there, but that's also providing exposure to the physical. Does anyone comment on that?
Yeah, totally agree. The other thing that Yellow Cake have is that very interesting contract that allows them to secure material about $100 million worth every year at the market price. So essentially, that's a very attractive proposition for investors who are trying to get in, particularly when the market's moving.
Okay. There was a question around the Black Swan event, safety issues in the industry, Fukushima 2011. How do you regard the new build and plant operations safety regulations applied in China and India compared with US, France, etc.? Is there a regional difference, or is the industry sort of fairly aligned in terms of the standards and qualities, certainly of new projects?
Well, I'll kick that off.
Yeah.
So I think that, one would think that there would be some difference, but I think that now with international standards being what they are and the need for confidence, I think that what you're seeing in China and India is their nuclear programs are matching or will be matching the history we see currently in the European and US reactor fleets or North American reactor fleets. So that quality of safety and quality of new build as we go along. They certainly don't, it would be against their interest to do a slipshod job and then have an issue they have to deal with after they've done such tremendous investments. So I think that they've got and also they want to be able to export their technology. So to export your technology, it needs to show it's safe and reliable. It is a competitive market in the nuclear space. As we talked about, Rosatom has basically set the standard for how it's done, but it doesn't mean that the Chinese are too far behind, and they want to be able to be competitive, and they have to demonstrate a good, safe program. It's why you see some of the shutdown of I can't say exact, Taishan nuclear power plant that was announced recently to deal with their fuel issue. It's better to deal with it now before it becomes a problem. Maybe we wouldn't have seen that in a typical operation maybe 10 years ago. I can't say that for sure because we didn't. But I do see that Fukushima brought about a high level expectation of safety that probably wasn't paid as much attention to at that time as it is now.
Excellent. And worth highlighting, whilst some historic events in the nuclear industry are very noteworthy and capture the minds of the public, they're relative to a lot of other industries, hydrocarbons industries, for instance. There have only been 3 real major incidents in the nuclear industry. So actually the safety record over time is actually quite exemplary. It's just, it seems to sort of stick in the minds because of the nature of the sector. So that's worth reinforcing the point there. A technical question that came in. I'm not able to comment on this, but is the fuel of SMRs the same as for conventional nuclear plants? Does that make sense? Can anyone tackle that?
It isn't. The SMR technology uses what's called high assay, low enriched uranium. Most light water reactors, as well as heavy water reactors, well, not heavy water, but the light water reactor fleet uses enrichments up to 4.95% U-235 content. That's the fissionable product. The typical SMR fuel is going to be what they call high assay, low enriched uranium, which is about 19.9% U-235 content. And if just for relation, not everybody knows these terms, but natural uranium is about 0.711% U-235. So it has to be enriched to low enriched uranium, but also to high assay, low enriched uranium. And it does require that type of fuel for, and also for some of the new advanced reactors that are being designed right now as well, in addition to SMRs.
Great. And can I just join on that comment for a moment, because it relates to something that Justin said in his presentation.
Yes.
And we are seeing a burgeoning demand center for this HALEU, or this high assay low enriched uranium, as a number of different SMR technologies start to progress and look more and more likely to come on board in the latter part of this decade. Justin mentioned in his presentation the diminishing role of secondary supplies, and in particular underfeeding, which is created from excess capacity in the enrichment market. What HALEU development will do is that will contract even further the capacity for underfeeding, or restrict even further the capacity for underfeeding. And that's because most of the planned developers of this HALEU fuel, they don't want to start from scratch at 0.7% uranium-235. They want to start with 4.95% uranium and then use their capacity to take it up to whatever it needs to be, as high as 19.9 for the particular SMR technology. So we will see additional demand of low enriched uranium, which will put pressure on existing enrichment capacity, and I believe totally squeeze out the capacity for underfed material to actually enter the market competitively with natural uranium products.
Excellent. I hope that's covered the point very nicely for the person who submitted that question. Thank you there. I've got a sort of question, and it relates to a lot of the ones that have come through, and it was one of the ones I'd pre-prepared, and it was, is there a tendency to put too much tension on the spot price at the moment, given the excellent fundamentals in the industry and right now? Perhaps as opposed to looking at the, the long-term price and the contracting prices.
I guess I'll take that, unless you, Paul.
Please. No.
I think in the long term, it's really the term contracting that has to come back into the market to really move the market overall, and that's really where you're going to see the highest volumes of uranium purchasing by end users will come through contracts. So the spot market, it's not that it doesn't matter. It clearly does matter, because it's the most visible metric that is updated, intraday, that the market can actually see. So it's what investors tend to watch. It also has an importance in that traditional contracts, even on a long-term basis, have some portion of that contract referenced to the spot price. So that's really what I'm kind of intrigued about with the financialization of the spot market that we're slowly seeing here, and potentially going to see increasing quite soon, is that you'll have a contract, for example, with, let's say, Cameco for a 5-year delivery term, where the price will be negotiated at a fixed term cost of, let's say, $45 a pound. And at 40% of the contract and 60% of the contract will be referenced to the price of the spot at the time of delivery. So I'm very intrigued by this, because as a utility fuel buyer, I don't know that I'm signing a contract for 2025 to 2030 delivery that's going to be 60% referenced to a price that's going to be essentially manipulated by financial players. I believe that these contracts are highly likely to see different metrics going forward, whether that's new projects coming online that could potentially do fixed price contracts at a much higher price. Maybe Paul or Brandon can speak to that. Their projects, maybe they would be willing to sign fixed price contracts at a much higher price. Maybe the spot reference portion will be less than we've seen in the past. But I would say no, I don't think the emphasis on the spot price is too much at this point, because it's become more of an important metric now than it was 5 years ago. And so yeah, it's something we definitely keep an eye on.
Of course, excellent. If anyone else wanted to add to that, or I can jump on to a couple of other questions.
I'll just add a bit, please, just to follow on to Justin's statement, is that the typical producer would look for both a blend of both market as well as fixed price contracting. I see the advantage of being willingness to sign fixed price contracting that will match what you need to incentivize your startup of production as a good way to base load, or at least to build that financial support for your new project. Also, for project financing as well, it provides that support for it. But from a strategy or contract book basis, you might find quite often producers will be looking at a blend of both market-related contracts or market-related sales, along with a base of fixed price contracts to support project development.
Excellent. We had a couple of questions that were touching on the potential bear case for the market, and excluding a sort of a black swan event that we've mentioned and someone else mentioned in a question. Are there bear case scenarios that could play out from this point in the market? Now, significant amounts of uranium suddenly coming online, for instance, hidden sort of supply sources, and anything like that that the panel could foresee or comment on. It's hard to look into the crystal ball, I suppose, to a degree. Yeah, go on, Justin.
Sure. I think the biggest bear case would be, let's say, a substantial change to projected demand. So if for some reason China or India just reversed course on their plans for nuclear, I think that would send quite a negative message to the investment case for uranium. I don't think that's going to happen. A black swan, obviously, some type of nuclear accident, God forbid, would be negative for the investment case. We're looking at like up and coming producers like Uzbekistan that's increasing their production year over year. They seem to be kind of like a Kazakhstan light right now. But given the demand that we're seeing out into the future, we don't think that that's going to disrupt the investment case. So I really think just a drastic change to projected demand is really probably the biggest bear case. But we don't expect that's going to happen given the momentum right now and the clean energy mandates that all of the countries are expressing right now, and the growth that the big players, the China and India, et cetera, are seeking in nuclear seems to be consistent and going to stick.
Yep, absolutely. Certainly doesn't feel that way. So I'll tie in a couple of other questions, and I think we'll cap it off there because we've gone quite over time. But there was a couple of questions around jurisdictions. Where is better for finding uranium? What jurisdictions are better or more supportive? Or perhaps we could take a bit of commentary there about what's going on in the global landscape. Someone's mentioned the EU not really having as much appetite for nuclear. France expanding, but sort of teetering on the refurbishment and expansion plans. Can we comment first on Europe and then talk about other jurisdictions in terms of their refining and nuclear capacity?
I think looking at the macro, so geopolitical positions of various parts of the world is fascinating. We're seeing the same sort of short versus long-term thinking in other critical elements, be it battery metals or rare earth metals, which are essential for that clean energy transition, where certain parts of the world are taking very long-term, very strategic views. And we've got a number of questions here about, is China looking for more material? Will Russia invest in any new mines? And the answer is absolutely yes. I mean, they have not yet covered their demand. Never mind the fact that they're exporting those technologies and would like to be a net surplus owner of uranium, because there is no substitute for uranium. It's an absolutely critical element to their infrastructure, to their GDP growth, to their urbanization plans. And it's very striking that we've seen that play out in rare earth metals in 2010, 2011. We've seen it play out in battery metals. It's playing out in uranium as well. And there doesn't seem to be a response really from utilities in the West. We saw a little response from the US government in terms of trying to promote domestic production, but it's a drop in the well. I mean, it's 4 million pounds if you're lucky, that let's say difference in approach to supply chain management, to access to critical materials, including uranium, is it's a very very relevant question today. Certainly, if we start to see other countries can start to build new inventories, and there are definitely moves amongst several countries to look at strategic inventories, much as China has done, that again has a very potentially disruptive impact on supply and demand in the short to medium term. So I think that is one of the key questions. The bottom line is $30 is not a sustainable price. It's not a price at which new supply is going to come into the market. And I think that's the exciting thing about everyone's business on this panel. But the really scary part is, what if more money than we expect, either from state players building strategic inventories or from financial players diversifying their portfolios, wants to start to get in before the market reprices? What happens then? And that's what we saw in 2004 to 2007.
Excellent. Anyone else have anything that they might like to add to that, or touch on those regional differences in terms of appetite for nuclear energy?
I'll just make one comment for any of the audience who aren't that familiar with our industry. It's very peculiar because almost all of the uranium supply comes from countries who consume very little uranium in the form of their own nuclear industries. So when you run through the list, Kazakhstan is the largest supplier. They don't have a nuclear power industry. Canada does, and they're one of the only two countries that have got any semblance of balance. Then you look at Australia, which doesn't have a nuclear power industry. Then you go to Namibia, which doesn't have a nuclear power industry. Niger doesn't have a nuclear power industry. And only when you get down to Russia do you find another degree of balance. And it's very much the same on the demand side of things. The US has virtually no current uranium production, as Paul knows well. France has no current uranium production, or no historic uranium production from within its own borders. It relies very heavily on securing Niger and other joint ventures around the world. South Korea has no uranium production and only fairly limited resources. That creates a geopolitical tension that very much goes to Riaz's point. If nations, for sovereign reasons, feel that they need to obtain better energy security for their nuclear power industries, with a few exceptions, notably America, they just simply have to buy the material and bring it inside their own borders. And that's been the Chinese experience, because try as they haven't had much success in expanding their own domestic uranium production. And they've been left with only one lever there, which is to invest either in projects and production or in physical pounds abroad.
That's fantastic, and that's outlined it very, very clearly, the state of play on the geopolitical front. Gentlemen, I think we're going to leave it there. We've shot over time, but rightly so. There was a lot to cover, and we've covered some excellent points. Jumped around a bit in the Q&A, but that's always good and always healthy. So I'll say thank you very much for viewers for tuning in. Thank you very much to my esteemed panel. It's been great having you tune in, and thanks for taking the time at your respective evenings and mornings to talk to the industry. So that's been a very good session. Thanks very much, everyone.
Thank you.
And I will say, of course, replays will be available, and we'll distribute those through our Assay TV website, and a link will be sent around to all participants as well. So thanks everyone for tuning in, and have a fantastic rest of the day.
Thank you.
Thanks so much.